Hi everyone, welcome back to satokoworld Finance Academy and satokoworld Financial Gym. And I hope you guys are starting to get sore with your finance. And yes, we are working on it and we're creating some financial muscle. And today we're going to talk about how to pay off debts quickly. On our last lesson, we have kind of starting to talk about debts overall, to what kind of debts there are and also how to pay off the debts, the method. And today we're going to dive into it, okay? And so before we starting to plan how to pay off our debts, there are some rules. Each category of our life, there should be some rules, right? And let's take a look at our rules here. So number one, make sure you have super emergency funds. Do you remember what the super emergency funds are? That is a physical cash that you would have it with you. So depending on the size of your family, it's between $200 and $500 cash with you. And recently I saw an interview of Warren Buffett. If you don't know who Warren Buffett is, please Google. He's the most successful investor in all time. He said in an interview that he carries $400 with him. So he even has the super emergency funds. And now rule number two, have $1,000 emergency funds. So this $1,000 emergency funds applies to those who have debts, okay? So because we want to pay it off as quick as possible, quickly as possible. And then rule number three, the student loan is paid on time. On our previous lesson, we've talked about how dangerous the student loan is, right? So we don't want to miss the student loan. We don't want to miss paying the student loan, all right? And then number four, rent or mortgage is paid. We need to have roof over our head, right? But there are some rules to that. So rent or mortgage should be less than 25% of gross household income. So gross income means before tax, and net income means after tax. So we have to get to know some, financial literacy as well, right? We have to have some financial literacy. So mortgage, it means that includes maintenance fee and also the property tax as well. So it should be less than 25% of household gross income. And if it's more than 25% that you're paying for your rent or mortgage, you might want to consider either getting more income. It could be like getting part-time job and you need to have more income, or get a roommate. So your portion of rent or mortgage will be reduced, or you could get a cheaper place. So those are the three options, all right? Now let's move on to rule number five. Insurances and utilities paid. Insurances could be your medical insurance, it could be car insurance, and utilities, it could be hydro, your cell phone, your internet, possibly cable if it's that necessary. And number six, have basic food money. So what I mean by the basic, it is regular grocery bill, not the steak dinner at the fancy restaurant, okay? And I want you to overestimate, I would say by $50 to $100, because we tend to spend more on the grocery without even knowing. So this is the 6 rules before we plan to pay off our debts, okay? And then now, we need to decide how much we're committed to pay towards our debts. Yes, the first thing, we need to make a decision, right? So this is what we're going to do. And then first things first, we're going to write down all the debts that interests are higher than 6%. Higher than 6%. And I think a few lessons ago, I explained why it's above 6%. Because the market long-term return is between 6 and 8%. And I wouldn't want you to miss out on the return in a long term either. So if the debt's above 6%, the interest rate's above 6%, we want to, get rid of the debts ASAP, all right? And then now, I have introduced on our last lesson about Snowball Method and an Avalanche Method, and it was very quick, so I want to explain very thoroughly here, all right? So Snowball Method, let's start from there. So let's say there are 3 debts this person's owe, and debt 1 is $500 owing, and then the interest rate is 10%, and minimum payment is $10. And debt 2 is $1,000 owing, interest 15%, minimum payment $25. Debt 3, $5,000 owing, interest rate 19%, and minimum payment $100. So on the Snowball Method, you're going to write it down, the amount of the owing from low to high. So just ignore the interest rate. You're just going to write low to high, okay? So that's 1, 2, 3, low to high. And this person decides to commit $500 a month towards the debt, okay? So now this is how it works. So month 1, so we're going to start attacking debt 1. So $500, we're going to attack the smallest one first, okay? So debt 2 and debt 3, we're going to pay the minimum amount. We can't ignore other debts, okay? That's because we're attacking the smallest amount. We need to pay the minimum payments. So debt 3, minimum payment is $100, and debt 2, minimum payment is $25. So rest of the money, everything goes to debt 1. So $500 minus $25 minus $100 equals $375. That goes to debt 1. So that would give the new balance of $125 for debt 1. And now debt 2, $1,000 minus $25 is $975. Now debt 3, $5,000 minus $100 is $4,900. So this is a new balance. So now this balance will carry on to month 2. And remember, we are going to attack the debt 1 first, right? So debt 3, minimum payment, which is $100. And then debt 2, minimum payment, we pay $25, right? And now debt 1, now we only owe $125. So we're gonna pay $125, and we're gonna eliminate the debt 1. And we still have leftover money, which will be $350. That goes into the debt 2, the second lowest one, right? So now, second lowest debt 2 is now going to be paid $375. And now the balance is debt 1 is gone, and debt 2, now we have $600, and debt 3, $4,800. And then you got the hang of it, right? And we keep doing that until we get rid of all the debts. So this is a snowball method. And this is actually tricking human mind. It gives you the momentum, but you might pay a little bit more interest. Well, you will pay more interest. But if you are someone who needs the momentum, this will give you the momentum to pay off the debts, okay? And then second way, that's the avalanche way. This is a method I actually prefer. But so same owing, but this time we're going to sort it from interest rate high to low. So we're going to write the debt 1, the highest interest, and then debt 2, the second, debt 3, the lowest, okay? And again, $500 a month this person committed to pay. And month 1, so this is how it works. So we're going to attack the highest interest first. So debt 1, we're going to attack this first. But debt 2 and debt 3, we must pay the minimum payments, right? So debt 2, we pay $25, and debt 3, we're going to pay $10. And now rest of the money from $500, everything goes to debt 1, the highest interest one. So now debt 1, $5,000 minus $465 that leads to $4,535 balance. And now debt 2, now $975. And debt 3 is now $490. And this balance will carry over to the month 2. And we're still going to attack the debt 1, right? And we're going to do the exact same things. And then at the end of month 2, the debts are $4,070 for debt 1, debt 2, $950, and then debt 3, $480. And just so you know that I ignore the interest, adding and stuff, just to make it simple, okay? So, but avalanche way, this is more practical because we save interest more than a snowball, right? But this, snowball way, you already got rid of the first debts, right? You only have 2 debts now, so psychologically you would feel like something is happening. Avalanche way, you really have to be laser focused, and then you must know that you're paying off the highest interest first. So you have to be really focused on it and don't get discouraged, okay? But avalanche way is my personal favorite. All right, so today's lesson was how to pay off debts quickly. Thank you for watching, guys. And if you want to work with me and expedite your financial health, please contact me at Satoko World Finance Academy. And if you still haven't, please subscribe. And if you like, please press the like button. Thank you, guys. And let's start wealthy and let's get wealthier. So I'll see you guys in 10 days. Bye.